All right, very good morning, everyone, and welcome to a brand new week ahead. Now, in terms of the week ahead, before we get stuck into the calendar, let's just quickly take a snapshot of where we finished last week across major asset classes. I think for me, the most sexiest moves last week to watch was the moves in US equities with the likes of the S&P as well as the NASDAQ once again back at all-time highs. You just love to see it. Look, if you're invested in any type of long-only account, that's exactly what you want to see, right? You want to see that money, you want to see those investments making money without you doing anything with it, right? It's making money because it's going up. It's fantastic to see. Regardless of how you feel about equities in the short term or the medium term, I love to see them trading in the green because it's doing very good for those investment accounts. So you love to see it at all-time highs. Very strong move for equities. It wasn't just in the US though. European equities did really well. Strong move there in the DAX as well, and volatility trading back down towards those recent lows close to 18. Apart from that, in terms of FX, the same theme has continued that has been in place for a while now, which is dollar downside. The dollar, weakest currency on the session last week, also had a bit of a dip to the downside in the Canadian dollar going into the end of last week, which we'll touch on in a second as a result of the tariff situation. But apart from that, the Swiss franc, frustratingly, still the strongest currency among the majors for a reason that I cannot explain. Look, if risk assets were still tumbling massively and we were still in a huge stress environment, then I would understand if safe havens like the Swiss franc is rallying. But inflation, rather say deflation, is a massive problem for the Swiss economy. The central bank has cut rates. They're expected at some stage to intervene to weaken their currency. We've got risk on sentiment. All of those things should lead to downside for the Swiss franc, and yet strongest currency on the week. It's been incredibly frustrating trading and watching that currency because it just hasn't been responding the way that I would have expected it to. Look, you're not always going to get it right. But when it comes to the Swiss franc, it feels like I'm way more wrong than I'm right, which is frustrating. It shouldn't be that way. So I'm happy to just keep that one on ice for now. I don't want to deal with that frustration at this stage. It's just been so frustrating to watch. But bottom line is dollar weakness continues even coming into the new week. And the Swiss franc remains one of the stronger currencies out there. The other currency that did fairly okay, I would have expected to see a little bit more upside, was the Kiwi dollar. We were mostly range bound, but I am expecting as risk sentiment continues to improve, I am expecting more upside for the Kiwi dollar from a risk on or risk positive point of view. If you compare that to the Aussie dollar, the markets have gotten excessively short the Aussie, but I think for good reason, because we've been talking about that divergence between the RBA and the RBNZ for a while now, saying that just as the RBNZ is looking to wrap up their cutting cycle, the RBA is expected to just start going with their cutting cycle, and all else equal, that should translate into some weakness for the Aussie versus the Kiwi. So even if both of them appreciate in a risk-on environment, you would expect the Kiwi to gain more ground compared to the likes of the Aussie. Now, apart from that, when it comes to oil or commodities rather, the big mover last week was, of course, oil. Massive amount of downside. I mean, we were trading down, still down 12% from last week's open. So pretty big moves there. Gold, been a bit of a strange one. For all the macro reasons on why the dollar is trading lower, gold should be trading higher for the same reasons. The reason why it's not is I just don't know, right? Gold has been a little bit of a Pandora's box for me when it comes to fundamental drivers. Some have made sense for upside. Some have meant more caution, especially in the short term, which is why I'm a little bit more cautious of it right now. But it has been a pretty confusing mover for me. I do think that based on the de-escalation we had in tariffs, the de-escalation we had in the geopolitical situation, I do think that should translate into a little bit more weakness for gold. But, that assumes that has been the main reasons for the upside in the first place, which I don't think it was. So if central banks, for example, start buying up a ton of gold again, it can go up again. We have seen ETF flows being quite positive for gold as well. It's just a little bit of a strange one right now. So I'm keeping that one on the ice But that was a surprisingly weak week when it comes to gold. Now, in terms of yields, downside on the back of expectations that we will be getting a very, very dovish Fed chair, possibly in the months ahead. That's obviously seen the markets starting to add a little bit of expectations towards cutting rates a little bit deeper towards the end of the year. The market was comfortable with expecting 2 cuts, and now we are building a premium towards 3 going into the last meeting of the year. So that is obviously why we had yields trading lower. So that is where we've been last week. Now, what about the week ahead? In the week ahead, we've got US data as the main focus point. Now, yes, we've got a couple of German inflation data points coming up. We've got UK GDP coming up, and we've got Swiss CPI coming up. But I would rather be forced to listen to Christine Lagarde for a whole day, non-stop, than trade the Swiss CPI data this week. I'm just not interested at all. If it's a massive miss, way below negative 0.2%, my baseline expectation in that scenario would normally be to expect downside for the Swiss franc. It's probably not going to go down because it doesn't seem like anything can force that currency down at this stage. So that is coming up, but I'm going to be avoiding that one like the plague this week. Now, main focus then will be US data. We get a couple of big ones coming up. We've got the ISM manufacturing. ISM manufacturing coming up tomorrow. Then on Thursday, this is important, guys. On Thursday, we almost get all of the important ones. We get non-farm payrolls, as well as the ISM services, as well as initial claims data, all taking place on Thursday. The reason for that is the US has 4th of July, Independence Day, bank holiday on Friday, right? So all of these key data points, which is normally released on the Friday, has now been moved to the Thursday. To be fair, the ISM services is normally on a Thursday, but NFP has been moved up to Thursday. So don't expect that on Friday. Normally it plays out on a Friday, but this week it's playing out on a Thursday. So just make sure that you plan ahead for that. Don't expect this to happen on. Don't expect it to happen on Friday as usual. Now, what are we expecting from these data points? Look, between all of them, the NFP is going to be the most important one because yes, normally, in a normal environment where nothing is clouded by silly tweets and tariff threats, normally ISM data offers fantastic tradable opportunities. If there's big surprises in either the manufacturing and the services, I've had some really good trades on the back of those data points. But in this current environment, the markets can't really trust that data because the data is very heavily influenced by the ongoing shifts in sentiment given the tariff situation. So because things have calmed down and because the US have agreed, right, they've reached a deal, which is basically just an agreement, right, to keep talking with each other. Because they've reached that, there has been some concessions made, and maybe that means there could be some more upside risk to the ISM prints compared to prior months. But again, I don't think that's going to be a big mover for the markets, at least as we usually would expect, because the markets will be able to discount that fairly quickly, whether it's good or bad. Which means the main focus point is going to be Thursday's jobs data. That's going to be the main focus point for the markets. We've got a couple of data points that feeds into it. Obviously, JOLTS will be watched, but that's May data. We get the ADP, which normally is a very bad leading indicator for NFP, which again means NFP going to be the main focus. Now, how are we expecting the markets to react to NFP? Let's talk about US equities first when it comes to this, because I think if we were to get the baseline assumption right now would be if we were to get good data, that should theoretically mean downside for equities because it means there's less need for the Fed to cut rates. Fine. But if the labor market remains strong, it's very difficult to want to be short equities because of lower rate cut expectations. Because if the labor market is still doing fine and growth is still doing fine, the economy is still doing fine, then why on earth would you not want to be long US equities? Right? So I don't think there's a play to short equities if the data is good, but you also want to be careful with buying it on bad data, because if the data is excessively bad, then even if there is expectations for rate cuts, The markets might not like that. Equities might not like the data coming in excessively bad because that's bad for earnings expectations or the forward outlook for earnings, right? For companies. But if the data comes in either flat or just slightly below expectations, just a small miss, I think that's like the sweet spot for equities this week, because a small miss would add to the hopes of Fed cuts, and a small miss doesn't mean anything for markets to be worried about from an earnings point of view for equities, for company stocks. So I think a small miss or as expected print could be really good for US equities in the short term. Hopefully, going into the data, we have a bit of a pullback so that we can buy it back from prior all-time highs, using it as a bit of a breakout retest continuation opportunity. We'll see. Maybe we just continue grinding higher and we just aim for something a little bit higher in the short term going into Friday. But I think that is what my strategy for equities, at least for now, will be going into Thursday. What about FX? Look, when it comes to FX, in line with the trend, in line with the macro view, arguably the simplest way to trade the dollar would be to hope for a massive miss in the data, which forces more expectations for cuts. If the data is bad enough, if the labor data comes in, like if we get like a sub 100 print on NFP, right? If we print below, let's say we print 85 or lower, that could be enough for the market to start contemplating a cut as early as July. Because to be fair, that's what Fed Chair Powell told us. He said, listen, we're not saying we can't do July. We can, if the labor market cracks, we can cut July. We haven't had Bowman obviously coming out saying that she's open to cut. So surely if the labor market sees a real big deceleration, then July could be live in terms of a cut. So that means the easiest way, or the simplest way arguably, to trade the dollar would be lower on a massive miss, because that'll increase cut expectations. It'll increase the reason for the markets to want to be short the dollar in the first place. In terms of levels to aim for that, that's what makes it slightly difficult in the first place, because what do you aim for? What do you aim for below? You've got a huge air pocket here. So I suppose round numbers could be attractive to look for, things like 96.50, 96, 95.50, 95, that could be levels to aim for. However, and having said that, even though trading in line with the sentiment and the macro view and the data would make the most sense, it's important here to understand that the dollar has been trading very stretched in the short term. This is what the dollar aggregate is looking at right now. And take a look at the percentiles across the majors. You've got so many currencies that is trading in massively stretched long territory against the US dollar. So the risk is that even if the data is bad, there's always the risk when positioning looks like this, that the market uses bad data as a reason to dip lower, take profit, and then you jolt back up. How many times have you seen that happen? Where the data comes in so bad, you expect more downside, it dips lower, and then you end the week with the dollar trading like 98 type of thing. Now, I'm not saying I'm not predicting that to happen. I'm just saying that there's a risk that bad data does something like this, but then you finish the week looking like this, just because these players take profit. So I would be cautious on chasing it lower, but that is certainly looking like the most simplest way to trade in the week ahead. What about if we get super, super hot data? Because of where positioning is sitting right now, and because of the lowered expectations of US exceptionalism and the higher expectations of Fed rate cuts, when you have positioning looking like this, if the data does come out massively strong, like a very, very strong print, that's probably the most attractive way to trade the dollar from a positioning point of view. But you have to be very careful with where you take profit, because any type of rally, the market will most likely look at that as an opportunity to get short again. So you do run the risk that if you trade it on the both the up and the downside, you'll have to start looking for some pretty shallow targets, I think, on either side of the dollar move, because of positioning on the downside, and then because of the macro view on the upside. So just keep that in mind as, I think, the biggest risk for trading the dollar going into that NFP. Now, apart from that, we'll need to watch out for any other developments on the tariff side. I think Friday's announcement that we got between the US and Canada was a bit of a surprise. We saw the CAD reacting very negatively initially, and then it basically paired almost half the move fairly quickly. I think that is exactly what we want to see. the markets are starting to get used to the tariff data or news. They're starting to get numb to the tariff data. And that's good news for us as risk event traders, because it means there's less of those things to worry about running you over. Now, we have to watch for announcements, of course. If there is any big announcements, especially with potential deals or anything like that, it can influence risk. It can influence broader moves. But of course, just be mindful of that in the background. But I'm hoping that the markets continue to just show a bit more of a ignores it a little bit more, and I'm hoping that continues, especially going closer towards that July 9th tariff deadline. So with that said, that is what we're watching for the week ahead. It's all going to be about US jobs. As always, any questions, don't hesitate to let me know.